On April 2nd, 2025, a date the White House chose to call Liberation Day, the United States announced sweeping tariffs on imports from nearly every country on Earth. Standard economic theory said one thing would happen: the US dollar should strengthen. More trade barriers mean less demand for foreign goods. Less demand for foreign goods means less demand for foreign currencies. Therefore, the dollar goes up. The dollar did not go up. Within hours, the US dollar index, the benchmark measure of dollar strength against a basket of major currencies, began falling. By the end of that day, it was down sharply. By the end of the second quarter of 2025, the dollar had posted its worst first-half performance in over 50 years, according to Morgan Stanley, a decline of more than 10% against its major trading partners. Over $5 trillion was wiped from U.S. stock market valuations in 3 days. Gold surged to record highs, and for the first time in modern memory, the phrase "Sell America" became a legitimate market narrative discussed not in fringe circles, but at Goldman Sachs, at JP Morgan, at the Federal Reserve itself. Here is what this event tells us about the foreign exchange market, the largest, most liquid, most consequential financial market on the planet. And here is what every investor, policy watcher, and anyone with savings in any currency in the world needs to understand about how this market works, who controls it, and what it means for you in 2026 and beyond. Let me give you the scale of what we're talking about. According to the Bank for International Settlements, the institution that serves as the central bank for central banks, global foreign exchange markets traded $9.6 trillion per day in April 2025. That is not a typo. $9.6 trillion every single day. That is larger than the entire GDP of Japan, Germany, and the United Kingdom combined moved through electronic systems in a single 24-hour trading cycle. And here is the number that I find even more striking, that $9.6 trillion represents a 28% increase from just 3 years earlier, when the BIS measured daily turnover at $7.5 trillion in 2022. The market is not just large, it is accelerating. Market size comparison, April 2025. FX market, $9.6 trillion, NYEC, $25 to $30 billion. US Treasury market, $700 to $900 billion tougher money. Global crypto, $3 trillion. The FX market moves more in a morning than the NYSE moves in a month. The foreign exchange market moves more money in a single morning than the US stock market moves in an entire month. And yet, and this is the part that should give any serious investor pause, most people who own stocks, bonds, or real estate have no idea this market exists in any meaningful way. They've never thought about exchange rates as something that affects them directly, until of course they do. Let's start with an almost absurd hypothetical. Imagine a world with a single global currency. In that world, there would be no foreign exchange market. A company in South Korea selling semiconductors to a car manufacturer in Germany would simply invoice in this single currency, receive it, and spend it. No conversion, no exchange rate risk. We do not live in that world. We live in a world of approximately 180 sovereign currencies, each managed by separate governments and central banks, each fluctuating in value relative to all the others based on inflation rates, interest rate differentials, trade flows, geopolitical events, and, as we saw vividly in 2025, the perceived trustworthiness of the governments issuing them. That reality creates an enormous, unavoidable, constant need every time a company imports goods across a border, every time a pension fund buys a foreign stock, every time a government services its international debt. A currency exchange must happen. That is the fundamental economic engine that powers the FX market. Here is what makes the FX market fundamentally different from the stock market, or the commodity market, or the bond market. There is no central exchange, no floor, no building, no bell. The foreign exchange market is an over-the-counter or OTC market. This means participants, banks, corporations, governments, hedge funds, and individuals negotiate directly with each other through electronic networks. Trading happens across every time zone simultaneously. FX traders in Tokyo are finishing their shifts as traders in London begin theirs. When London closes, New York is in full swing, When New York winds down, Sydney picks up. The result is a genuinely global 24-hour-a-day, 5-day-a-week market that never truly sleeps during the trading week. An exchange rate is simply the price of one currency expressed in terms of another. If EURUSD is quoted at 1.1800, it means 1 euro buys 1.18 US dollars. The euro is the base currency, the currency being bought or sold. The US dollar is the quote currency, the measuring stick. When you travel internationally and convert money at a bank counter, you're participating in the retail end of this market. The rates you see on those boards are derived from, though usually significantly worse than the interbank rates that banks trade among themselves. People use the FX market for 3 broad reasons. First, commercial necessity, multinational companies converting revenues. Second, hedging, companies locking in future exchange rates through derivatives. Third, speculation. And here is the uncomfortable truth. The overwhelming majority of daily FX volume is driven by speculative trading, far more than commercial trade or hedging combined. This is not a scandal. Speculators provide the buy and sell orders that allow commercial participants to execute their hedges efficiently. But it does mean that currency prices, particularly in the short run, are driven as much by trader psychology, positioning, and momentum as by underlying economic fundamentals. That tension between what an exchange rate should be based on economic theory and what it actually is based on market dynamics is one of the central paradoxes of global finance, and it's at the heart of what happened to the dollar in 2025. Before we go deeper, a brief pause. I publish new analysis on macroeconomics, monetary policy, and global investment every week. If this kind of structural analysis is useful to you, the subscribe button is just below this video. It takes 2 seconds, and it's how I let you know when new content is available. Now, back to the market. Let's talk about where this market actually lives. According to the BIS 2025 Triennial Survey, 4 jurisdictions alone account for 3/4 of all global FX trading: the United Kingdom, the United States, Singapore, and Hong Kong. London is by far the dominant center, capturing nearly 38% of global FX turnover, more than New York and Singapore combined. This surprises people. The British pound accounts for only about 10% of global FX trades. So why is London the center of a market dominated by dollars, euros, and yen? The answer is historical and structural. London sits in a time zone that overlaps with both Asian morning sessions and North American afternoon sessions, a unique liquidity advantage built on centuries of financial infrastructure. In fact, surveys consistently show there is more trading of US dollars in London than in the United States itself. I want to walk you through the most important single data point in global currency markets. The US dollar was on one side of 89.2% of all foreign exchange trades in April 2025, according to the BIS. This figure has been remarkably stable for decades, 88.4% in 2022, roughly 88% in 2019. Why does the dollar appear in nearly 9 out of every 10 currency transactions? The structural answer: the dollar serves as a vehicle currency. If a Japanese bank needs to buy South Korean won, the most efficient path is JPY, RU USD, RU KRW. 2 transactions using the highly liquid dollar market, rather than 1 transaction in a thin, illiquid direct market. This network effect is self-reinforcing. Because everyone uses the dollar as the vehicle, it remains the most liquid, which means it remains the vehicle everyone uses. The 1944 room that changed everything. July 1944, Bretton Woods, New Hampshire. 44 nations, 1 agenda, design the post-war monetary order. John Maynard Keynes proposed a supranational currency, the Bancor. The US delegation, led by Harry Dexter White, rejected it. Result: US dollar becomes official world reserve currency, convertible to gold at $35. When the gold standard collapsed in 1973, the dollar stayed dominant by inertia and network effects. That conference room shaped global finance for the next 80 years. According to the IMF's currency composition of official foreign exchange reserves, the US dollar's share of global central bank reserves was approximately 72% in 2001. By the end of 2024, it had fallen to 57.8%. By mid-2025, it stood at 56.3%. the lowest recorded since at least the mid-1990s. The Federal Reserve's own economists, in a paper published July 2025, confirmed this trajectory. From a peak of 72% in 2001, the dollar's reserve share has declined by roughly 16 percentage points over 2 decades. To be precise about what this means, the dollar has not been replaced. The euro holds steady at around 20%, the yen at around 6%. The Chinese renminbi, despite years of expectation, holds only about 2%, constrained by China's capital controls. What has happened is a quiet but deliberate diversification into what the IMF calls non-traditional reserve currencies: the Australian dollar, Canadian dollar, South Korean won, and increasingly gold. Central banks added more gold in 2024 than in any year in modern history. This is not a crisis, it is a structural shift. A glacier moving, not a dam breaking, but glaciers given enough time reshape landscapes. 3 currency pairs, UR/USD, USD's rate JPY, and GBP/USD, collectively account for roughly half of all global FX trading volume. The entire $9.6 trillion daily market is, in significant part, a story about the relationships between 4 currencies: the dollar, the euro, the yen, and sterling. Not all currencies float freely. The idea that exchange rates are set by pure market forces is true for some currencies and largely false for others. Governments face a genuine policy choice about how much control they want over their exchange rates, and that choice has profound consequences. Argentina, a cautionary tale. 191, Argentina pegs the peso to the USD at 1.1, inflation collapses, growth returns. 1999, Brazil devalues. Argentine exports become uncompetitive. The peg becomes unsustainable. 2001, system collapses. Bank accounts frozen, peso devalued overnight, debt defaults. Millions of middle-class Argentines lose their savings, denominated in safe dollar-equivalent pesos. Lesson: fixed exchange rates work only when fiscal discipline maintains the foundations. The system doesn't fail. The political will to maintain it fails. The Argentina case is not a cautionary tale against fixed exchange rates per se. It is a cautionary tale about the conditions under which fixed exchange rates work, and the catastrophic consequences when political pressure allows fiscal discipline to erode the foundations of the system. Ecuador dollarized in 2000 and has maintained it successfully for over 25 years with reasonably sound fiscal management. The difference is not the system, the difference is the discipline. Japan is a fascinating example of the dirty float in practice. The yen technically operates under a floating rate, but the Bank of Japan and the Ministry of Finance have intervened dramatically at various points. Most notably in September-October 2022, when the yen fell past 150 per dollar and authorities spent tens of billions to stabilize the currency. In the summer of 2024, similar intervention occurred when USD2 JPY approached 160, when no major government is truly passive about its exchange rate. The most ambitious attempt at currency integration in modern history is the Eurozone. As of early 2025, 21 EU member states share the euro, overseen by the European Central Bank in Frankfurt. The Eurozone accounts for roughly 15% of global GDP. The fundamental problem of the Eurozone is one economists identified even before it launched. Monetary union without fiscal union creates an asymmetric shock problem. When a crisis hits member states differently, as the 2008-12 sovereign debt crisis devastated Greece, Portugal, and Spain, while Germany recovered quickly, the ECB cannot calibrate monetary policy for each country's specific needs. Rates set for Germany's health may be catastrophically wrong for Greece. The European response has been ongoing: a banking union, fiscal rules, and most dramatically, the EU's Pandemic Recovery Fund. The $750 billion Next Generation EU, which represented the first significant European-level debt issuance. Economists widely interpreted this as a tentative but significant step toward the fiscal integration that the Eurozone's architects deliberately avoided in the 1990s. Now let's come back to where we started. April 2025. Liberation Day. Standard international trade theory is clear. Tariffs should appreciate the tariff-imposing country's currency. Major investment banks, Goldman Sachs, Deutsche Bank, Barclays, had all published research in early 2025 suggesting Trump's tariff agenda would be bullish for the dollar. They were wrong. The dollar fell sharply and kept falling. A paper published by economists at the Center for Economic Policy Research analyzing high-frequency data from the exact moment of the Liberation Day announcement documented something striking. Currency markets moved in ways that contradicted standard theory entirely. The dollar weakened against virtually every major currency simultaneously. Their explanation: foreign institutional investors, pension funds, sovereign wealth funds, insurance companies held enormous quantities of US dollar assets after more than a decade of dollar appreciation. When confidence in the US policy outlook deteriorated, those investors didn't wait. They rotated out of US assets and back into European and Japanese assets. The act of selling US assets and buying foreign ones requires selling dollars. The selling pressure overwhelmed the theoretical trade effect. Scale of the shock. April 2025. S&P 500 over $5 trillion in market value erased in 3 trading days. DXY H1 2025 fell 10.7%, worst first half performance in over 50 years. JP Morgan, MSCI World ex USA plus 19.5% H1 2025 versus S&P 500 plus 6.2%, RBC Wealth Management. Gold plus 65% for full year 2025. J. Safra Sarson. Silver, 145% for full year 2025. UR/USD plus 13.5% gain in 2025. Largest annual UR gain since 2017, MUFG Research. What were the specific factors that converged to produce this historic dollar weakness? Each one is instructive about how currency markets actually function. The initial tariff announcement, followed by partial pauses, exemptions, negotiations, reversals, and new threats against the EU, against Apple specifically, created something perhaps more damaging than a clear permanent tariff regime: unpredictability. Investors can price a known bad outcome. They cannot price randomness. The Bloomberg Dollar Spot Index fell over 7% from January through May 2025. As Bloomberg reported, precisely because market participants couldn't model U.S. trade policy even 90 days forward. In May 2025, Moody's Ratings stripped the United States government of its final remaining top-tier credit rating, downgrading U.S. sovereign debt from AAA to AA1. The U.S. had already lost its AAA from Standard & Poor's in 2011 and from Fitch in 2023. The Moody's downgrade was the symbolic completion of that process. For the first time in modern history, no major rating agency considered U.S. government debt to be risk-free. The catalyst was the congressional debate over the One Big Beautiful Bill, a tax and spending package that the Congressional Budget Office estimated would add approximately $4.1 trillion to the U.S. national debt over 10 years. The optics of the world's reserve currency issuer pursuing aggressive debt expansion simultaneously with erratic trade policy were, for many international investors, deeply uncomfortable. In mid-July 2025, comments about the potential dismissal of Federal Reserve Chair Jerome Powell caused the dollar to fall 1.2% against the euro within a single hour, according to JP Morgan Asset Management. Central bank independence, the institutional principle that monetary policy is made by professional economists without direct political interference, is one of the foundational reasons why dollar assets have been considered safe for 4 decades. Any perceived erosion of that independence is, for institutional investors, an existential concern. The combination of factors above created a coherent narrative articulated explicitly by fund managers at major institutions that it was time to reduce U.S. asset exposure. Not because U.S. assets were worthless, but because the risk premium required to hold them had increased. The practical result: international stocks dramatically outperformed U.S. stocks in the first half of 2025, reversing a decade-long trend. As RBC Wealth Management noted in November 2025, over the past decade, persistent dollar strength enhanced U.S. equity returns in foreign currency terms. If the U.S. dollar is transitioning to a secular weakening phase, those dynamics could reverse, turning a long-standing headwind into a tailwind for globally diversified portfolios. The dollar's weakness in 2025 did not occur in a vacuum. It occurred against a backdrop of accelerating de-dollarization efforts by BRICS nations, continued Chinese expansion of renminbi-denominated trade agreements, record central bank gold purchases as an alternative to dollar reserves, and growing European fiscal integration that was gradually making the euro more attractive as a reserve asset. Gold, the oldest alternative to paper currency in human history, rose approximately 65% in 2025. Silver surged 145%. Both moves reflected a single underlying signal. Some portion of global capital was seeking alternatives to the existing dollar-centric reserve system. By early 2026, the dollar had partially stabilized but remained significantly below where it started 2025. MUFG Research, in its December 2025 FX Outlook, projected a further 5% decline in the DXY over 2026, targeting UR/USD at 1.24. The firm's view, the structural drivers of dollar weakness, U.S. growth deceleration, expanding fiscal deficits, continued rate differentials, had not resolved. J. Safra Sarasin's FX strategist Claudio Wavell, speaking in early 2026, described the geopolitical and policy inconsistencies from Washington as likely to continue generating headwinds for the dollar, even in the absence of macroeconomic catalysts. Let me now pull all of these threads together. We started with $9.6 trillion per day, a number almost impossible to visualize at human scale. It is helpful to remember what generates that number. Every international trade transaction, every portfolio investment across borders, every central bank reserve rebalancing, and most volumetrically, every speculative trade by every hedge fund, proprietary trading desk, and algorithmic system on the planet. The FX market is the plumbing of the global economy. When it functions smoothly, it is invisible. When it doesn't, when currencies move violently, when exchange rate regimes collapse, when reserve currencies lose credibility, the consequences cascade through every other asset class in ways that affect every investor, saver, and borrower on Earth. We trace the dollar's rise to dominance from Bretton Woods in 1944 through the collapse of the gold standard in 1973, through 4 decades of dollar hegemony, and the slow erosion of that dominance occurring over the past 25 years. We examine the architecture of exchange rate systems, from currency substitution to currency boards to adjustable pegs to managed floats to free floats, and the hard lesson that Argentina, Zimbabwe, and others learned about the conditions under which these systems succeed or fail. And we looked closely at 2025, the year the dollar's worst first-half performance in 50 years demonstrated vividly and expensively that currency strength is ultimately a function of institutional confidence, not just economic fundamentals. What should a global investor take from all of this? 3 things. Exchange rates are not background noise. They are central to investment returns for anyone with international exposure. The MSCI World ex-USA outperformed the S&P 500 by 13 percentage points in H1 2025, driven partly by dollar weakness. Currency moves can add or subtract 15% from returns in a single year. Understanding FX is not optional for global investors. It is foundational. Reserve currency status is not permanent. The British pound was the world's reserve currency for 2 centuries. In roughly 30 years, 1914 to 1944, it lost that status. 2 world wars, fiscal overreach, loss of confidence. The dollar's trajectory from 72% to 56% reserves over 2 decades is not a crisis, but it is a direction. And directions, when they persist long enough, become destinations. The FX market is relevant to every investor, everywhere. Whether you are a pension manager in London, an entrepreneur in Singapore, or an individual investor in Vietnam managing a portfolio of international assets, the foreign exchange market is operating beneath every decision you make, repricing your returns in real time. The $9.6 trillion daily machine never stops. The question is whether you understand what it's doing and why. The foreign exchange market is an active evolution. The dollar's position in 2026, the renminbi's internationalization trajectory, the euro's role in a more fiscally integrated Europe. The rise of stablecoins as a new form of synthetic dollarization in emerging markets. These are all stories that will develop over the coming years with enormous implications for global capital flows. I cover these structural shifts in depth every week. If that kind of analysis is useful for you, subscribe below and I'll notify you when new work is published. I'm curious about your perspective. The dollar is still the world's dominant reserve currency at roughly 56%, but it's been declining for 25 years. Do you think the dollar's reserve status is fundamentally safe over the next decade? Or are we watching the beginning of a more meaningful transition? Leave a comment below. I read all of them and they often shape future topics. The real question this analysis opens up, the one I haven't fully answered yet, is this. If the dollar's dominance is in slow decline and no single alternative has emerged to replace it, what does a multi-currency reserve system actually look like? What happens to global financial stability when no single currency commands unquestioned trust?